Welcome to the Broken Pie Chart Podcast, episode 328. I'm your host, Derek Moore. Congratulations, market. You got back to 6,000. 6,000.36 to be exact, after really gaining 61.06 points. That's, a little over 1%. Congratulations, you did it. And it looks like those who bought the bottom or stayed invested are being rewarded. Those who got out, and it always happens near the lows, or those who said, well, I'm going to get out, or I'll wait and get back in later. This time that didn't work. And doesn't mean it wouldn't have worked in 2000, 2001, 2002, 2008, 2009. But so far, I mean, we're within 2.4% of an all-time high, the previous all-time high that we hit February 19th, all the way back February 19th. I mean, that was only, what is that, 4 months ago? Less than 4 months ago? So, I mean, it seems like it's so far, and we don't know what's going to happen going forward. I'll let you know when I know. It's sort of a V recovery. I mean, the very low, the low close on April 8th was 49.82.77. And what did I tell you? We closed 6,000 and change today. So congratulations, market. I'll point out that while I don't often make predictions, it wasn't really a prediction, but I just said, I forget how many shows ago it was. I said, if you asked me, do we put the lows in for the year? I said, probably. Doesn't mean we're not going to make a new low. But so far, so good. So what's sort of interesting about this market, though, is there's, I'll call it dispersion. And dispersion not only in some of the big names like the Mag 7, they're not all performing or doing the same thing. Goldman Sachs put out something on market breadth. And market breadth, if you're not familiar with what that is, and this is right in the Goldman Sachs chart I'm going to reference. It's calculated as the difference between the distance of the aggregate S&P 500 index. That's, fancy for saying the S&P index from its 52-week high, and the distance of the median S&P 500 constituent from its 52-week high. When the aggregate index is much closer to its 52-week high than is the median stock, market breadth is narrow. And right now we have narrower breadth. So the reason why I say this is interesting is, remember, in leading up to, especially through December of 24, it seemed like everything was going up in tandem. And, people made the point that the Mag 7 was really driving everything. We had started to see the rest of the market start to participate. But right now, not all the stocks are all doing the same stuff. Remember their Sesame Street, which of these kids is not like the other? And there's like 3 kids playing basketball and 1 kid playing, baseball. Some of you might get that. If not, Google it. I'm sure you can find those. But yeah, we're seeing dispersion. And I think if you look at something like the S&P 500 or SPY versus the RSP. RSP is an equal weight index, meaning the S&P, the bigger the stock, the more weight it has in the index. So NVIDIA, Apple, Microsoft, Broadcom, which again is AVGO, those have bigger weight than Yeti coolers. I think Yeti is still, you know what? I'm not even sure if Yeti's in the S&P 500. But I do have one of their cups on my desk right now filled with water, and it stays awfully cold. So getting back to the equal weight index versus the S&P 500, pulled up on Bloomberg, a 120-day correlation. And correlation is probably, this goes back to June of last year, so a year ago. And correlation right now between the RSP and the SPY is about 0.9417. So a little over 94%. Compare that to July of 24, it was only 72%. Go back to February of this year, 80%. And it really was, I think it's fair to say they all sort of went down going into April 8th, and they're all going back. It doesn't mean they're up the same, but we're seeing correlations there. Now, you compare that and contrast it with, I don't know. Let me pull up like Microsoft and Apple. And Microsoft and Apple, its correlation is only 58% right now. Certainly not all going up the same. Microsoft, I think, recently made another all-time high. Apple did not make another all-time high. So the reason I bring this up, one, the market breadth certainly is narrower, but the market is, you're seeing some stocks depart from one another. Certainly Tesla of late, especially in the last week with the Elon Musk and the Trump dust up, I should say. You saw, Tesla really get punished. But generally they're not all acting the same. Despite that, the market just reclaimed 6,000. And, if I look at from April 8th, so from April 8th, or I guess maybe I should do this from April 9th, if I want to see, the difference in the return. Tesla's up only 8.43% total return since the low close on April 8th. Compared that to AVGO, which is, of course, Broadcom. Interesting story there. I remember listening to a podcast, and when Avgo had merged or bought, I don't remember what the exact details were, Broadcom, they didn't negotiate the ticker. Remember, Broadcom was what? Is it BRCM or now I forget what the ticker was. But it's up 33.37. NVIDIA up 23.96. Microsoft up 20.68. The S&P up 10.21. And Apple up only 2.68%. So I'm not going to go through every company, but I just thought it was interesting to look at that. The Mag 7, and I'll look at MAGS, that's an ETF, good as ETF as any, I suppose, to look at what the Mag 7 is collectively. I'm sure there's an index, but that's the one I usually pull up 13.5% off the lows. So they're not all acting the same. Apple really hasn't, Apple closed, what was it, above 200, but it's not making new all-time highs for sure. So why do I bring this up? The reason why I bring this up is remember the argument was it's only the Mag 7, or it is only, all the stocks are moving up. This is sort of a stock picker's market. And I still believe in buying the index because you get the benefit of the different stocks, and you also don't have the pain of owning a single name or just a few single names. But it is, I think, shows a little of the resilience in the markets. And I like the fact that the RSP has a high correlation with the SPY because it means there's a little more broad participation. Now, we look at Tesla, we look at United Healthcare, there are others. It's a great example of the benefits of just owning the index. We did a paper, Jay Prestocelli and I, a number of years back. We looked at the volatility of single stocks and how even single names can gap down pretty big due to earnings, due to any other things. We had examples in there. I'll put a link to it in the show notes. It's on our website. We do a lot of concentrated stock management where somebody has a lot of shares. Maybe they worked at a company and they got shares. They have a low basis. So if they sell it, they take a big tax hit, but they want to generate income or hedge it. Those are things we work with. And some people just, they bought NVIDIA a long time ago and they just held on to it. And it grew. And now they have a concentrated piece of their wealth in NVIDIA or Apple or Microsoft or any of these. So I'll put a link to that in the show notes. You can check that out. But it's a great example. I mean, if you're a Tesla shareholder, and like, I don't know what's going to happen with Tesla, it's still up off the lows, but it had a rough day. I think it was Thursday. Was it Thursday? Had a little bit of a rough day, recovered yesterday. Certainly. I think it recovered 10 points or something like that. But you have key man risk there with Elon Musk. You have, certainly political risk, I suppose, now. And I will just tell you, this is not the podcast to listen to for analysis on Musk and Trump. I feel like it could have been handled better on both sides. Like, if it seems like there was a better way to sort of exit that situation. And anyway, we'll see what happens there. But it's a great example of single stock risk, key man risk. You have a very public, I wouldn't know who else is, if Elon Musk was going to step aside from Tesla or one of these companies, like, who is a strong replacement for him? I don't actually know that. I'm not an analyst on Tesla. I'm sure the analyst could tell me. But this is why if you have very concentrated wealth, I like the idea of hedging that. And if you want to generate income too, there's ways to do that. But all right, so let's talk about Tesla. We got to do it. If you look at Tesla, the VIX index, if I look at the VIX, it's going down. And it keeps going down as the market's gone up. It has a 17 handle now. Tesla's volatility, on Thursday, it hit almost 80. It's implied volatility. And what I'm doing is I'm looking at what's called the 30-day implied volatility at the 100% moneyness. And that means just fancy way for saying at the money. So when we talk about moneyness with options, if a call option is 10% out of the money, that would be at the 110% moneyness. If it is a call option that's 20% in the money, we would say that would be an 80% moneyness. And puts work a little differently. So, yeah, it implied volatility 80 when the VIX has a 17 handle. It closed Friday at 67.98. And look, if you are, I'm just going to look at, let's say, next week. So, yeah, that's next Friday, June 13th, Friday the 13th options. And at the 100 moneyness, so that's right around 297.50. Those are a little money in the money on the calls, a little out of the money in the puts. In the money on the put side, a little out of the money on the call side. It's like 0.8% out of the money, 0.8% in the money. So, right now the implied volatility of those is 81. It's 81, somewhere between 81 and 82. And what that means is if you were to buy the straddle, meaning you think it's going to move, and you say, I don't care which direction it goes, I just think it's going to move. You're going to pay like $24 for the straddle, something that expires next Friday. And $24 means, the stock closed today at 295.14. That means you actually, in order to not lose money, your break-even price is 319.14 on the upside. And then on the downside, for you to not lose money, it would have to get down to 271.14. So implied volatility being higher means that the option market is forecasting a greater degree or a greater probability of higher moves. And typically the premium on options is going to be higher. And so Tesla is departing. Now, single stocks on their own, they're going to have a higher volatility than the S&P as a whole, because the S&P, you're buying 500 companies, albeit the highest ones or the highest weighted companies drive more of the index. But yeah, it's being priced in right now at an 82% volatility. Its 1 day expected move is basically about 5.2%. So much more than the market. All right. The other thing, I'm trying to think if there's anything else with Tesla. No, I think we covered it. Single stock risk. I'll put a link to that. The other thing I thought I'd mention too is normally you think about the Dow Jones as being less volatile than the S&P 500. And the thing is that, I mean, the S&P is a weighted index, meaning a market cap weighted index. So all the companies that are in there, the 500 plus names, there's actually more than 500 that, like, you have Alphabet, 2 different share classes, things like that. But you look at that index and it's weighted 1 through 500 and whatever. And the biggest company has the highest market cap. Market cap is just the shares outstanding times the price. That gets you the market cap. Where the Dow is price weighted. So I bring that up because United Healthcare, when it went from 600 all the way down to, what was it, 290 or so, that was a really highly weighted stock in that index simply because its price was so large. So, and think about it this way. When Apple did, what did they do? A 1-for-7 split? It was a number of years ago where I think they went, was it 1-for-7 or 1-for-10? I forget. But imagine you're trading at 1,000 and then you do a 1-for-10 and now you're trading at 100. It means your weight in the Dow would go way down. So the Dow has actually been a little more volatile of late just because of what's been going on with some of the higher weighted stocks. Now, as the price comes down in United, and I don't know where United's going to go, you can, I'll let you know in 6 months whether it's up or down. But that weighting has actually come down, but its impact was pretty great there. And the reason why the impact was great is because it's a price weighted index, which it's still weird that they do that. I mean, I get it because in the old days, I mean, maybe before splits or, I don't get it. I'm sorry. I don't know. I mean, does anybody buy? I mean, people buy the DIA, which is the ETF. That's the Dow. I mean, there's 30 companies in the Dow Industrials, and don't get me started on the local news when the markets are in turmoil. They put the little chart of the Dow in the lower right-hand corner. And I'm like, really, the Dow? All right, let's move on. So where are we as far as different sectors, different markets, and its percent to new highs? JC Peretz put this out on Twitter. He said, great look here from macro charts. Okay, so he's crediting macro charts. Still think, and this is a quote, still think most or all of the red box, and I'll explain the red box, could make new highs before a bigger correction is seen. And he says he consistently does some of the best work on the platform, must follow. Okay. So what they're referring to is the Dow Jones. Let's see. Yep. So the S&P is we talked about that earlier, 2.45% away from a new high. The Dow Industrials made a new high. The NDX, the NASDAQ 100, 2.12% away from an all-time high. Financials, 2.6% away. Consumer staples, 2.9%. Utilities, 2.7%. Then you have energy, 17.55% away from a new all-time high. And by the way, when you're 17.5% away from an all-time high, and its decline at the worst is minus 22.92%, it's not that far away from a bear market. It's closer to being a technical bear market, being 20% or greater down, than it is to make a new all-time high. Healthcare, no surprise there, because United Healthcare, 17.5% away from a new all-time high. But I mean, look, the S&P was down 21.35. That might be intraday. I'd have to go back and look at that. I believe that was intraday. But the point is still that, look, I mean, these things are, it's good reminder of why it's very, very difficult to try and be handsy in markets and try and trade in and out of markets. We prefer just to buy the market, just be hedged. That way, you've got investments, and if the market is really moving lower, You may have some stuff in there that is providing an offset, going up in value with everything else is going down. And there's real value in that. And I always tell people, sometimes people say, why do some investors need a financial advisor? And my answer is always the same. If I can stop you from making 3 bad decisions and help you make 3 good ones over the course of a decade, that alone is worth something. It's very, very hard to stay unemotional in markets. And sometimes staying in the markets and doing nothing is the best thing. Riddle's Wealth put out a graph, and it's the S&P 500 rolling 10-year return. So on a rolling 10-year basis, so you think about 1980, it was 1970, or 1979 would be 1969, 1970. You get the idea. And what's the annualized return, or the rolling? And really, there's only 3 negative periods. And that is, let's see, it looks like 1930s into 1940. You had, and that was negative. This one actually never went below 0, but it's touching the 0 line in between 73, 74, probably right around 74. And then you had 2008, 2009. Other than that, the markets have been positive. Now, at this point, I'm supposed to tell you that past performance is no prediction of future results. But if history teaches us anything, it's that markets have been pretty resilient. And imagine at those lows, if somebody had sold. They sold and they said, I'm going to wait in cash. I'm going to see what happens. I mean, even if when you look at 2000 to 2002, the rolling 10-year return was something like, 150% or something like that. So stay invested, stay hedged. Don't panic in markets. I know I talk about this all the time, but I hope I help some of you just kind of keep your heads. And, there's stuff day to day. There's always a reason to sell. There's always a worry in the markets. And yet, I mean, think about all the stuff that's happened. Vietnam, World War I, World War II, any number of things. And the markets never make a new all-time low. You'll see all-time highs. When will we see an all-time high? I don't know. We'll see it when we see it. But be invested, be hedged. All right, that's it this week, and we'll be back next week. The recommendation continues to be watch playoff hockey. The Stanley Cup Finals are on. We've seen, at this point, Florida Panthers and Edmonton Oilers are tied 1-1. The game went 2 overtimes last night. Marchand scored on a breakaway. Hockey, I won't do too much hockey analysis, but if you haven't watched hockey before, these games have been really good. Top players. McDavid on the Oilers is, I don't think I've ever seen anybody skate like him and be just respected as being a dangerous player, like in a good way, from the opposition. There's no lead that's sort of safe in these finals. And I remember watching Gretzky and Messier and all those guys. Gretzky's the greatest ever. But I think McDavid's a better skater. I really do. And Florida is very, very deep. And so I wouldn't be surprised if it goes 7 games, and we'll see what happens. So check that out. I continue to watch Your Honor, which is a show on Netflix. I'm through about 6-7 episodes of that. And Bryan Cranston, who, he was in Breaking Bad. He's in a lot of stuff. And, just check that out. I'm through about 6-7 episodes. I feel like it could have been a movie, to be honest with you, but I'm not giving up on it. Like, I've liked it so far. I want to see where it goes. I'll give it a chance. So, all right, that's it for this week, and we'll talk to you again soon.